Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, it's the Summer Box Office Grand Prix. IMAX CEO Richard Gelfond on how F1 is revving up global revenue. And in a volatile market, it's nice to get a regular check. We'll tell you where to find yields as high as 11%, plus how pipelines can power your portfolio. But we begin with our expert panel and their investment ideas for the second half of the year. On the Barron's Roundtable, my colleagues Jacob Sonenshine, Teresa Rivas, and Andrew Bary. So, Jacob, heck of a first half, a massive correction, and then a bounce back like that. But if you had the stomach to just stick with those AI trade, the momentum stocks, you did pretty well.
You did pretty well. If you're somebody right now that's looking to put new money to work in the market, I wouldn't go for the momentum stuff. Feel free to hold it. Long term, that's going to be great, but they're getting a little bit expensive. The Nvidias, the Microsofts of the world, the large cap companies that can do really well almost no matter what, excluding recession. The cheap stuff, middle to smaller market cap stocks, you're going to find some bargains in there.
Reversion to the mean is a powerful force. That momentum ETF is up 14% this year. And if you look over a longer term time period, huge spread between what the S&P has done and what those momentum stocks have done.
Yeah, a big spread, about 14 percentage points over those 3 years. The key is that when it gets into that area, typically momentum starts to lose momentum. And you do want to look for some of those cheaper stocks.
Already, good advice. Always the contrarian, right?
Yes, one of them is Marvell Technology.
Oh, interesting. That's a chip maker, right?
Yeah, so Marvell makes very specialized chips, smaller market than your Nvidias and your advanced micro devices, but they're participating in the AI trend. That's at this point the majority of their business. The stock's been knocked down from about 50 times earnings to about 24 times. So not super cheap, but if it keeps growing and meeting expectations, I do think the stock can do pretty well.
In that universe, that is kind of cheap.
Yes.
Growing at 40%
Absolutely.
a year. Teresa, I do not envy you. Investing is hard enough, predicting the unknowable, et cetera. But you have the added problem in retail of what are 14-year-old girls going to like 3 months from now? What athlete is going to say something stupid and tank the stock of his shoe endorser?
Well, as a former 14-year-old girl, you should fear us. But I agree. Consumer discretionary has been really out of favor this year because no one really knows what's going on with tariffs, which just adds another layer to the problem. But I will say I think value is still something that's winning. Value doesn't always mean the cheapest price, but over the past few years, inflation has really trained consumers to get the best bang for their buck. So something like a TJX, something like a Five Below, even like a Costco, consumers are really conscious of what they're getting for their money at a time of inflation, and I think they'll keep winning.
Let's take a quick peek at the high end of the market. We just saw these photos from the Sanchez-Bezos wedding. She's carrying the Kelly bag. She's sporting the Hermes scarf. How is Hermes looking? How about other companies in that very top end?
Well, I wasn't invited, sadly.
No?
But
you could have been my +1. Sorry about that.
Of course. Yeah. No, but I think that Hermes will continue to outperform. They are really at the high end of the market. And that aspirational consumer that is more geared towards some of LVMH's lower tier products is still just really wondering if they want to spend on luxuries at a time when inflation's still biting. But again, I think the very high end is not going to have that issue.
All right, let's stay in Europe, Andrew. For years, investors have been in the U.S. have been punished for doing the right thing, which is diversify overseas. Finally, this year, they're getting rewarded for it.
Yeah, I mean, one of the big investment stories this year has been the revival of international markets. You're seeing some of the major markets returning 20% so far this year in dollars to U.S. investors. Germany's up like 30%. That's versus more like about 5% for the S&P 500. And interestingly, one of the big boosts to international investing has been the dollar, which has had it coming off its worst first half in decades, down around 10%. That's added to returns for U.S. investors. I think the international rally does have legs.
The Swiss franc is up more than 14%. Maybe it's a little bit of a safety trade right now. If investors like this idea, how should they play it?
Well, you can buy ETFs like the ticker iShares IEFA or Vanguard Fund ticker VEU. Emerging markets have also been laggards. You can buy the emerging markets ETF like IEMG, and individual stocks in overseas often have liquid U.S. ADRs, and that includes like oil stocks like Shell, BP, BHP, and also some of the auto companies are Toyota, Honda, BMW, Mercedes, as well as ASML, which is the leading semiconductor capital equipment stock in Europe.
They pretty much own that market, right?
Yeah, they own that market. And it's a well-run company, and it's kind of like an NVIDIA of Europe.
So you mentioned some index funds. Some people, of course, active managers always say they'll do better than the indexes, but there is an argument that, well, overseas you got to be more selective. Do you buy that?
Yes, I mean, I think you really add value overseas by stock selection and market selection. I mean, Brandis has a very strongly performing small cap fund, and so that's one example. And this is an area where I think active management can really make a difference.
All righty. Thanks very much, Andrew.